a new edition of Raising the Bar Live, where we talk about how to raise the bar in your insurance plan. And I have two friends with me today. Gabby Morella, who is an attorney and runs a captive, and Nancy Giacalone, my friend, fellow broker of the year, by the way, um, also captive nerd like me. So we thought we would answer all the questions that we're getting, and please feel free to hop in, answer a question, and let us know if we're not answering your questions. So welcome. Thank you for joining me today.
Thanks for
So
having me.
I think we'll get right to it. Nancy, do you want to kick us off?
I do. So our intention with this is to ask the questions that you might want to ask, but maybe you're a little bit nervous about asking because you feel like you should know the answer, but you don't know the answer, or you kind of know the answer. So we're just going to start right off, and Gabby's our expert. So we're going to fire questions at her. And we're going to start off with, okay, let's start with the basics. What exactly is a captive?
Okay, so it's a great question, and we were just talking about the phrase captive. It seems to be that everybody's using it, it's a buzzword, but there's a lot of, I should know what this is, but what is it? So I'm going to give a broad explanation because it can be, there's all the different variations on the market, but simply put, a captive is a licensed insurance company which is owned by its insured entities. So if you're an employer, you would set up a captive insurance company for a level of self-funding. And the big thing here is to think about you pay premium to your captive for insurance instead of paying it off to a commercial carrier. So it's a way to invest in your own business through something you're already utilizing, which is insurance premium.
So how is that different from when my broker or consultant talks to me about self-insurance? It sounds like it's kind of the same thing.
So self-insurance is slightly different in the sense that in self-insurance, you are funding your own, let's take the medical stop loss field because that's what we're specializing in. You're funding your own health plan and paying claims out directly from that self-funded health plan. So in a captive in our model, we're doing that. You're self-funding your own health plan, but then the captive is over above that health plan to provide extra protection, extra risk once claims and expenses hit a certain retention point. So it's there as extra protection for the self-funded health plan.
Okay, cool. Well, that makes a lot more sense to me. So I think that a lot of employers and consultants are familiar with captives in the workers' comp space, as there's a huge popularity for that. So how does a medical captive differ from a workers' comp captive, or does it?
So if we want to talk about specifics of programs, there's program X for workers' comp, program B, they all have different specifics, same for medical stop loss. But the core element is the same. It's just the type of insurance coverage, which is self-funding certain insurance coverages, whether it's workers' comp versus health benefits for your employees, and using a captive for those benefits. So really, I mean, to put it simply, the difference is the insurance type. Now, if you want to get into the specifics of different programs, that's a different discussion. But a medical stop loss health insurance captive is not much different than workers' comp model.
Well, I do see a
question.
Yeah, I was going to address one of those because it kind of goes back to my first one. So one of the people on here said, so is a self-funded plan, so it's a self-funded plan with an extra layer of risk mitigation. So does that describe a captive?
So yeah, that's a good way to go ahead. Were you going to say something?
I was. In my mind, and I might be have a different perspective here. Risk mitigation is how you manage risk, right? So what are you doing to contain your risk? Are you using all the tools that we use, right? All the buzzwords, right. Direct contracting and transparent PBM and direct primary care and all of that. So I think risk mitigation is separate from insurance protection.
Yeah, and that's fair. So the way that the captive works to get a little bit more involved is what you're self-funding your own health plan, then laying off a level of the risk through the captive, which is shared with common captive participants. So while the captive participants, and specifically the captive manager, should advise clients on risk mitigation tactics. The captive in itself is a way of pooling risk together to provide an extra level of insurance protection to its participants.
So when we explain self-insurance to employers, we often say that when you're self-insured, basically you're keeping the profit that a traditional insurance company would make for yourself. You're just not spending that money, right?
Mm-hmm.
Is it fair to say that when you are entering a captive arrangement, that you're doing the same thing for your stop loss or large claim protection?
Correct. That's the end goal always. Now, as an insurance company, some years are profitable and some years are not, but the general goal is for this to be profitable. It's to lay off a portion of the self-funded risk to the captive and have that be a returnable asset to your business.
I think that that's a great explanation, because I think that's the hardest piece for people to understand, is the difference between a captive and a traditional self-funded. It's like, okay, well, what's the captive doing exactly? I'm part of this group, but I don't get it. I think it's attractive to a lot of people when they look at the numbers that are associated with it.
Right.
But I think that a lot of clients don't move forward because it's intimidating, because they don't feel that they have a full grasp of how it works. And I mean, I'll be perfectly honest with you. It took me years to understand how a captive worked. I mean, I had a parade of vendors come in here and sit down and draw me pictures and pyramids and all these different things. I had to be like, okay, yep, nope, still don't get it.
Yeah, I think it's common to jump when you're talking about captives to jump into the specifics. But sure, the analysis of how everything works with the flow of funds will happen eventually, but you need to set the common level of understanding first. And that's what we're doing today.
Right. So again, let's talk about who a captive is right for.
Okay.
So I tend to work with smaller employers. And when I say smaller, I'm talking in terms of the insurance world. So maybe have an employer that has 50 employees and they're all covered on insurance. We have at least 50 lives. And the employer says, well, this sounds great, but I've always been told I'm too small to do self-insurance. Is a captive a good way for them to enter into that arena?
Yes, and that's a great example, because right, the self-insurance may not make sense, but because with the captive you have the element of sharing risk with other participants. 50 health plan covered lives is enough to enter into a captive arrangement that I'm speaking about. So it allows kind of combined premium pricing and employee lives to be able to enter into an arrangement that you may not have been able to do on the self-funded market individually.
Can we talk a little bit about how that works? So if Nancy and I are in the same captive, let's say the three of us are in the same captive, then we each pay our claims up to a certain point.
Correct.
And then our money is pooled, right? That's called the captive layer, but there's a pool of money. So if, let's say that my annual maximum is $100 and each of your annual maximums are $100. And one year I spend $150, then you two are giving me the $25,
Correct.
Now next year, Gabby, you might spend 110. So Nancy and I are each giving you $5. And then the third year, maybe Nancy, you spend 125. But in those other years, we're spending less money. So we have excess money. No, so let's say that something terrible happens and we spend more than $300. There's insurance after that to protect all of us from that, right?
Correct. So a captive insurance company will likely engage an excess insurance carrier in your analysis with the 100 versus 300 for these high severity claims, who will step in and cover that to protect the captive program. So there's multiple layers of risk financing and risk management here. First at the self-funded plan, then through the captive layer, then there's an excess carrier on top to protect for those high severity claims. And then in terms of your analysis of, 1 year you may be paying somebody else's claims versus not in other years, then there's a profit analysis meaning those who contribute to the profit of the captive will get money back in the year that they contribute to the profit. But if you contribute to the losses, you may not get as much money in that year, which makes sense from, a fairness perspective when you're sharing risk amongst participants.
So this, for somebody that doesn't live in our world,
right?
This is like, so what are the questions that they should be asking if they're thinking of entering a captive arrangement?
So the business needs to have adequate cash flow in terms of the capitalization requirements. So they need to understand how the capitalization is structured, but it's not a high barrier to entry. You just need to ask that question. Mm-hmm. You also need to think about this as a long-term investment. The captive transaction does not work for a 1 year in, 1 year out person. And I'm not saying this to steer away business, but that's just the truth of it. We say, you need at least a 3 to 5 year investment to really see the benefit here. And then your education also grows in these 3 to 5 years. Maybe you want to take on more risk, understand things a little bit more. That's where we see it to be the most beneficial for employees.
From an accounting perspective, how much of that work lands back in my office? Do you have audited financial statements? Who is responsible for the checkbook?
Okay, so the captive manager here is going to be someone you need to vet out the captive manager and feel comfortable with the services that they're providing. So a captive manager is likely going to be providing the accounting and financial reporting services for the captive. So they will be managing the books and records. Obviously, the captive owner will be involved in reviewing and all of that and making final decisions on the financials, but these services will be performed for the captive in conjunction with the management fee of the captive manager. Also, captives are state regulated, therefore audited financial statements are required. So a third-party accounting firm who's independent will be coming in and doing a full review of the entire captive program, which will again be provided to the captive owner. So this is another level of protection for the captive owner to feel comfortable with kind of the financial standing of not only its own captive, but the entire program.
So again, I'm going back to my group of 50. Everything you just said, I'm overwhelmed and I'm getting sick to my stomach just thinking about it because it feels like a lot. But when we get back to the basics of it, we're talking about that employer with 50 employees, right in that range. They've wanted to try self-funding for a long time. It seems too scary to them from a financial risk standpoint. But if we look at a captive, they're entering into a self-funding pooled risk arrangement in many cases. So not as much risk is on them individually. So it can be an advantage for them. But then they have to understand there are some additional details, accounting, management details that they have to be prepared for. But again, group of 50, they might not have a controller. They may not have a dedicated HR person. Can a group like that reasonably consider a captive?
Yes, they can, because if you don't have the controller, you don't have the HR person, someone in the business is doing those job functions for the business. So this is just an add-on to that. Now, I'm not going to say it's not an additional workload, but it's not an overburdensome additional workload. And then there's the service providers that help support the captive and the captive owner through the captive manager, the TPA, the consultants. They're all there to make sure that this program will function efficiently. And so the business isn't really doesn't need to take on new employees to run a program of this nature. They just need to make sure that they understand how to do it. And once it's implemented, just continually do so with the help of the service providers that are out there, basically providing the infrastructure for this.
So it would sound to me like the role of somebody like Allison or myself as a consultant is vitally important in the implementation and day-to-day ongoing effective management of a successful captive program.
And we have a perfect question from one of our viewers about that. It says, what about compliance? Are there additional requirements with a captive? And I want to spend a couple minutes here because I think this is really, really important.
Okay, I'll answer one, then followed by the other. So first, regarding the consultant, yes, the consultant is a key person in this process. You need to trust your consultant. Your consultant needs to be involved in the process from day one to understand how the claims are processed. What can they do to be kind of helping with implementing the health plan, claim review, communication with the captive manager. Sorry, my screen just kind of went blank. Okay, we're back. Anyway, you probably all saw me, didn't see myself there, but so yes, the consultant is a very important person to bring in from the beginning for this to be effectively implemented. And then in terms of regulatory overview, legal compliance, yes, a captive is an entity. It is regulated by various state jurisdictions, as I said. However, the captive management company should have a oversight over this and making sure that the captive is being regulated in accordance with the applicable laws and regulations. There should also be legal counsel, someone in the process to make sure documents are being implemented appropriately, all rules and regulations are being followed by taxing authorities. So really, that shouldn't be anything that the consumer, the captive owner, is involved in, only other than understanding what is required and how it's being accomplished.
Are the requirements different from what a self-funded or frankly, a fully insured plan requires?
On the health plan side, no. The changes are really at the captive level. What levels of shifting and sharing of risk do you need to meet to establish that? But again, the captive manager takes care of that. You know, if you ask them, they can give you a full detailed explanation, but it is technical. As long as you're comfortable with the program that's already been implemented, you don't need to worry about that. Check it off your list. Compliance is handled.
We've got another question here from Adam Aguilar. He says, I think it's important to highlight with the client their maximum financial exposure, not spinning it as at risk or shared risk.
And that's a fair point. If you're entering into a captive, there is financial risk involved. And it's an investment in your own captive insurance company, in your own business. So that's something every business owner should do when they enter into a business transaction. And those questions are important to ask. And any good promoter of these types of structures, any good captive manager will feel very confident explaining that to the potential captive participant, because it is something that you need to understand and know.
I think that that's also a big portion of that falls on advisors like ourselves, Allison, because there are people that spin it. Oh, this is great. You're going to have an opportunity to make money. You're going to get all this money back. But we have to show the risks and rewards, and that includes showing what the total financial risk is. We can say it's unlikely you're going to get there, but you could, and you need to account for it. And I think that's true whether it's a captive or a self-funded plan or even a fully insured plan. There are commitments that the employer makes when they enter into any sort of agreement.
Correct. And I think that 7-year claim conversation is very important to have. You know, typically you're going to have a year or two that are so fantastic, you're not going to know what to do with yourself. One is going to be dreadful. You'd like to hop out the window. And 3 are going to be okay. 4 are going to be okay. And when you look at it that way, you'll typically come out so far ahead that it's worthwhile.
Right. The risk shouldn't be the barrier to entry if you're comfortable with what the risk is, because the benefit should outweigh the risk. We can't say here with certainty what will happen in the future, but we can look at practical experience and numbers for rate of return and different types of investment statistics.
We've got a question from our friend Aaron, who's asking, in self-funded, we also see risk in the runout. Are captives built with similar runouts of 1224, et cetera, for those that leave the captive?
Great question.
Yeah, so we've seen different types of runouts in the market right now. Traditionally, we're pricing at 1218. However, if 1224 is something that is requested, it can be quoted and priced for the captive participant. It just might be that you're paying a premium load for an additional runout coverage. It all just depends on what the captive participant wants. But the good thing to know here is a captive is flexible. It is what you want to make of it. So you have a lot of control over your own captive because it's your business. There's transparency with the captive program. So any discussions are open to the captive manager and to the captive program. We welcome them and encourage them.
We have another question here from Hale Stewart. It says, will the plan participants see a meaningful change in the way they access their benefits?
I would say yes, always, because again, transparency is key here. In terms of the plan participants, nothing really changes for them. It's just as well as they're going to go to the doctor, they're going to process things, they're going to get an insurance card. That's fine. The plan participants won't really, they'll be happy to have the insurance coverage and go on day to day. The benefit goes is to the plan owner, the plan sponsor, the employer, is that they can have more control over the benefits that they're providing to their plan participants. And that's the real benefit.
I want to tack on something here. We notice in our level self-funded and captive clients that the ID cards no longer say Blue Cross, United, Cigna, Aetna, and Humana, which is going away anyway. And that can sometimes be a small hiccup in the doctor's office. So we spend a lot of time communicating about, okay, this is your network. And we literally send out an email with a copy of the ID card and the number to call, because that seems to be a challenge. And I'm hearing that from advisors across the country. It's easily solvable, but it does require a member to say, no, you call this number to verify benefits. And then that is the end of that issue. But again, I think that goes to the honest conversation of what are the speed bumps. But the coverage can often be richer with a captive, correct?
Correct. And having advisors, consultants who are aware of, you're entering into X transaction, this could be the small hiccup. If you don't understand it up front, then you'd say, captive thing is very confusing for my employees. Why wasn't I aware of that? That's why these conversations need to be had up front. But they're an easy thing, like you said, Allison, to overcome. They just need to be a conversation.
And being in a captive doesn't mean you can't have a network. It just means that as the builder or the constructor of the plan, you may choose not to, but you may have a nationally known network as part of your plan if that's what's needed. So being in a captive doesn't preclude that if that's the direction you choose to go.
Yes, that's exactly correct, Nancy. So what we say is, you can rely on your consultant, other captive participants to select the best-in-class service providers, networks, whatever the case may be. What works for your business and what works for your business today may change in the future. The good thing about the captive model is that you have flexibility in crafting the structure to be what you believe is best or what you want for your.
And I think that's a great point, because we try to build plans that provide enhanced benefits to members while at the same time reducing the overall spend to the plan, so that we can continue to enhance benefits as we move forward, instead of having to always dial them back. So that kind of leads into my next question, because what if we're in a captive and one plan builds a very aggressive a plan model that has all the cost containment features in place, but another plan sponsor doesn't? How does that affect the overall captive, or should they be in the same cell together, or do they need to be in different programs?
So every captive program should have underwriting guidelines for pricing, as well as oversight in terms of the risk that, each captive is taking versus ceding to the risk pool, and making sure that first that it's legally compliant and that no one is being put at risk versus another unfairly, because the underwriting guidelines are established to make sure that the premium pricing is accurate. That's essential. Then you have an actuarial team behind a captive who is going to vet everything out to make sure that the captive as a whole is not exposed to risk that it cannot take. Because if you do not have that opinion, you're not going to get approved by the regulators. So this is being done from day one, or you can't enter into a captive transaction. Now, if one participant wants to take on some more risk versus another, there's ways to structure that where maybe not all of the risk is shared amongst the captive participants. Again, this can be flexible, but there will be set guidelines to make sure that risk has been evaluated by advisors who are licensed to do so.
Can we talk a little bit about, since we're talking about pools, do pools need to be homogeneous? Do they function better when they're heterogeneous? What are things that I should consider? So I think if I'm a high margin business, right? If I'm a professional service firm or I'm a SaaS company, my margins might be 30, 50, 70%. Why would I be interested in doing this?
So, I mean, high margins are great, but what's better than that is maybe higher margins. So you have the cash flow, you have probably the ability to engage in this risk financing transaction without, putting in a ton more effort. So it's kind of a no-brainer in my mind there, because you can just implement a captive, pay the premium that you would otherwise be paying for health insurance for your employees, and potentially and likely reap some benefit from that. So that's the main, play, I would think, for a higher margin business.
And what if I'm the reverse? What if I'm a nonprofit, a manufacturing firm, somebody that works with food industry with small margin, 3, 5, 10%?
So again, it's a great way to increase the profitability of your business without, going out and selling a new line of products, which probably takes a lot of investment to put into place, or starting another business venture. As long as you can meet the capitalization requirements, the underwriting guidelines are met, you can pay this otherwise expense to your captive and hope to get a profit back, which increases your business's profitability.
So a term I hear you keep using, and I'm going to want to clarify it for our audience, is capitalization requirements.
Correct.
What does that mean, and what does that look like?
So every captive program has a different capitalization requirement. Through our main program, it is a function of premium. So the more premium that you're paying to your captive, the higher the capitalization, which is directly related to the amount of lives that are on your health plan. However, it's not a high barrier to entry, because the whole captive program has already been capitalized over the years from all of the participants. So an individual captive isn't going to have to put in an insurmountable amount of money. There's also the ability to finance over a 12-month period. So a 12-month installment buy-in isn't as tough to swallow as writing one check day one.
So what you're saying is capitalization is upfront money. It's an investment that the employer or the plan sponsor is making into the captive. Is that correct?
Correct. And
okay.
Go ahead. Sorry.
That's okay. Go ahead.
No, I was going to say, so capitalization as a business is like capitalization in any business. It's your basis in the business. It's your money. So when you would potentially decide to depart the captive, as long as you didn't need that capitalization to offset expenses, you would eventually get that back as well. It's not shared with the other captive participants unless needed from a risk exposure standpoint.
So does that stay on the employer's P&L or balance sheet, or does that completely off?
That is going to be on the balance sheet of the captive. It is a separate business.
Okay. And then my last question regarding this capitalization, because I think it's something that people get really hung up on. So let's just say that the plan has an annual spend of $350,000. What would be an approximate? We're not holding you to anything, and we're not counting lives, but is it 10%? Is it 5%? Is it 50%? Well, just for round numbers, what would be a capitalization number so people can visualize it?
So the way that we're doing it is 25% of net written premium. So you take the gross premium that you pay to your captive less the excess premium fees to get to a net amount. So if you're looking at 350 as the premium value, then subtract out, let's say 50, and then so 25% of 300.
Okay.
So let's talk about that for just a second, because you're talking about premium.
Correct. I'm not talking about self-plan.
You're not talking about claims.
Right.
You're not talking about claims, right? So basically, for those of you that are listening, insurance costs fall into 3 buckets. Claims costs, administrative cost, which is the cost to run the plan. It's the captive manager fee, it's the TPA fee, it's the broker fee, it's what it costs you to fill prescriptions. And then there is the insurance bucket. So the insurance bucket you're paying to yourself in a captive arrangement, and it is about a third probably of your spend of your total $350,000.
Right. Thank you for clarifying that, Allison, because
Sure.
I think that's an important differentiator, because 25% of $350,000 is a lot different than 25% of, let's say, 100,000.
Correct.
Right. And $350,000 in premium would be a large captive participant. That
Right.
wouldn't be your 50%
Right.
participant.
Yeah.
Anywhere you're looking there, far below $50,000 as a capital, probably below 25,000. I can't give you exact numbers.
No, that's okay. I was just trying to get an idea,
Yeah,
so
but
people could understand it a little better.
And we've not had the comment that the capitalization ever is too hard to meet. The capitalization has never been the barrier to entry in the captive program.
And since it stays on the balance sheet, then those funds belong to the employer. And if the employer chooses to exit the captive, and there are always provisions about this, it's really important to understand what they are because they will vary per captive. But if you meet those provisions, typically they're a time length. You need to stay 3 or 5 years, 2
Correct.
years sometimes. Then you exit with your capitalization.
Correct. And there could be a tail period where you exit day one and there's a time period to get it back, but you will get your capitalization back as long as there's not extenuating circumstances where you owe money back to the captive arrangement.
And those extenuating circumstances should be spelled out in the contract. And
Correct.
as an employer, you should read the contract.
Everything should be clear from the contract. And if you have questions, you need to ask them because then they should be in the contract.
Mm-hmm.
So I'm going to actually go back to the one question I asked earlier with regarding to the balance sheet. Now, I know that the money that the employer spends on the capitalization is on the captive's balance sheet, but does the employer carry it anywhere on their balance sheet?
It's an asset as they own the captive.
You're right. So they can, I just wanted to be clear about that because that is important for businesses, especially that are, having to deal with annual financing from banks or anything. So just to know that is still technically, depending on what their CPA says, it can potentially still be carried on their balance sheet.
Yes. So the captive is its own business, but if the employer owns the captive, it's their business. So it's like owning any type of subsidiary or different type of investment vehicle. That's an investment in yourself that, if it's profitable, it becomes an asset of the owner.
Could we, since it is an asset, could we talk a little bit about the tax treatment of that asset?
Is there a specific question about the tax treatment of the asset or just generally speaking? Because it's a technical question, so I don't know how far I should go.
Can you talk about how the money can grow, can grow tax-free, and what happens when you repatriate those funds?
Yeah, so there's different tax structures within captive insurance arrangements. And one is the income, the growth of the captive is not taxed, only the investment income. So the interest income, what's coming off of that asset. So while it sits in the captive, it can grow and grow and grow, and you're not going to be taxed on that growth until you would then take a dividend back to the captive owner. So it's a good investment vehicle as well. The ultimate goal is to have profit, let it grow, and then when you need the funds, bring it back to the employer, and that's when the ultimate distribution is taxed.
And they're typically taxed as long-term capital gains.
Correct. As long as you're holding the asset for over a year, it's going to be long-term.
And we've got 2 more questions. So one is a cash flow management question from Adam Aguilar. Is there a drastic cash flow difference month to month for the client? It might be a barrier. Claims are fluid, high months and low months. And let's deal with that one first because that is a valid concern. Yeah.
So again, before you enter into the transaction, there should be a cash flow analysis. There should be a projection of what your health plan bucket spend is going to be, what your captive premium spend is going to be. And so those numbers will be presented to you. It's no different than, looking at the premium pricing for what you'd be paying for your insurance on the commercial market. That's going to be an upfront discussion. And then potential participants going to look at the numbers. So that information is available from day one. We get in the information, we provide the quote, we provide that information out to the potential participant, and then that's really where discussions start with questions and getting into the details.
And I'm just going to throw in there that there can be lots of questions here, and they should all be answered
right,
completely and fully, because this is a cash flow. Normally it's fine, but you just need to understand what's happening. And it takes, Nancy and I have been doing this a long time. It took us a few rounds to understand this, and we do this every day. So sometimes it takes a little bit, and I think sometimes that's why people find it off-putting.
Yeah, and before you hop on to the next question, can I just make one more comment about that? I think cash flow is something we don't talk about enough in this industry, period. I have a client that's in the, I don't know, 75 lives or something. They're terrible. They don't pay their bills on time. I know their cash flow is a mess, and they're always asking me about self-fund. And I tell them, I mean, I'm very straight up. I'm like, no, I won't. You can buy it from somebody else, but you're not buying it from me, because the liability and the risk, you're not prepared for it. You can't handle it, as they would say in the movies. But I will tell them very frankly that they're just not a good a fit. And I think that, again, when we go to the role of the broker, consultant, advisor, whatever you want to call us these days, is it's so important that we have those very honest conversations with our clients, because we don't want to be caught in the middle either.
Well, no,
Exactly.
Nobody wants it to fall back on them. Like, I was told this. When you get into a cash flow analysis, if the answer is not clear, if you're looking at numbers in front of you and the captive program can't answer your questions, that's a red flag. Transparency is key when we're looking at figures. Now, if we can't project what will happen, sure, that's a risk element. This is insurance. But if there's not an answer to how it's going to be handled, that's a problem. And the other thing is, we're sitting here, we're saying you don't need more employees. You don't need XYZ to participate, but you do need to run your business effectively to be able to add more business lines to your current business. So if your cash flow is not there, you're not paying your bills on time, the premium payments aren't being made, right? This might be just a little bit more than you're ready for initially. Doesn't mean you can't work up to it, but there is a level of engagement that is necessary.
And I think that cannot be underestimated.
Right.
The role of the consultant or advisor is very important, and you do have to stand up and say this might not be the right thing.
Correct.
We have it bombarded with questions, Allison, so I'm gonna let you take it away.
Oh, geez.
So I think the question that we should spend a little bit of time on, and we've got a couple after that, is can you comment on potential IRS issues with a captive?
So the IRS is investigating captives, specifically micro captives, 831B captives, and a lot of our captives are 831B captives. That's not something we shy away from in our promotion. However, there's a few things that we differentiate in certain programs. First, this is health insurance. This isn't, property and casualty risk or various different lines of employment coverage, such as, directors and officers liability, cyber liability. This is health insurance risk, which is truly passed on to the individuals on the health plan. The insured, the employer, does not have control over the risk. That's a big differentiator with the current IRS review. So, and then again, when you enter into a captive, not only do you have your own workforce to differentiate the various levels of risk requirements, but you have everybody else's employees. So there's a ton of risk distribution in these types of programs.
Is it fair to say that the IRS views a risk where money's coming in and out of the captive on a regular basis, which it will here, differently than an enterprise risk like a D&O issue, a fraud issue, a cyber issue, where you're accumulating so much cash?
100%.
Captives can be profitable.
Right. The IRS is attacking a circular flow of funds. So you pay funds up here, they come back down here. Here's you pay funds up to your captive, and the goal is to achieve an underwriting profit, but nobody should be achieving 100% of that underwriting profit.
Right.
There's risk involved. And these claims will need to be paid. Again, it's not Me as the captive owner, I decide whether I make a claim to my captive. Your workforce determines when the claims are made. And then there's, the hospitals, the medical providers. They want paid. They're making those claims. These are going to be submitted to the captive carrier.
So we've had a couple of comments about cash is king for small business, and I think we would all agree about that. Keeping more of it is beneficial. And then we have a question from Susan Combs. She asks, is this something that is more prevalent in different states? In New York, the only captives we have seem to have been for large governmental agencies, or for example, the 9/11 Trade Center Fund is a captive here.
So yes and no. There are certain states which have stricter insurance requirements that sometimes make it harder to implement captives, but we're willing to implement we're willing to review and see if possible in any state. There's I wouldn't say we're closed off in any state currently.
So New York has some specific regulations about self-funding. You have to have 100 enrolled before you can do self-funding. So the market is a little bit different there.
Right.
Washington State has some peculiarities. Hawaii, California.
We're special.
Let's be honest. New York's a tougher market too. But again, that's why I say, we just need to have the conversation if there's an interest with like what your client's risk profile looks like, what are the rules and regulations to see if it would work.
Very good. Okay, I think we covered most of our questions. Are we missing anything, Allison?
We are missing just my obsession with high-cost drugs.
Oh, yes. Oh, that was a great one. I love this one. So let's not leave this one alone because I'm obsessed with them as well.
High-cost drugs are a problem. So yeah, it's a hot button issue.
So Susan has a follow-up question. Says, so you have stop loss with this, correct? So small group would be out, right? So in New York State, you need to have 100 enrolled to be self-funded. So yes, it would be out for small groups. In other states, that's not the same. We have much smaller groups that are self-funded, level funded in a captive, whatever. But even in a captive arrangement, there is stop loss protection. You're just paying much, much, much less for it because so much of the risk is either absorbed by you or absorbed by the captive, the group of the captive.
Yeah.
Okay. Back to those.
Okay. So I'm a little obsessed with high cost drugs. It's a bad habit, but there are some very expensive drugs coming in the $800 million and $2 million range. A captive needs to address that issue, correct?
Correct.
And you should clearly outline that in your contract, how those types of things are covered, because different stop loss contracts cover them differently. And I don't think that people are aware of what that can do to a plan and how it's important to mitigate.
Yeah, so this has been a big issue. It's been on the top of our radar, and when we're vetting excess carriers, because these are likely going to be excess claims, we have to ask these questions about what's covered and what's not. So that needs the excess insurance markets out there for certain types of coverage. However, you, like everyone's saying, you need to ask the questions about what specifically is covered because there could be exclusions. So that needs to be an upfront conversation. And that was a conversation that we had with our various excess contacts when we were repricing for this year. Mm-hmm. The other thing is the captive participant, the captive owner needs to know what's coming up on their health plan. So, a good captive staff will have a clinical team available, a pharmacist to review kind of what's out there. Is this the correct treatment for the condition? These are things that the captive is reviewing and providing, because not only does it protect the individual participant, it protects the collective participant. And that's the power that you get with the captive, is we're looking out for everybody within the program.
And I would say that a good consultant is looking at those as well. I know Alice and I are obsessed with them. I know. I just recently changed PBMs for one of my clients, and they're like, "You want the weekly claim files?" I'm like, "Yeah." I'm like, I have to see them. I want to see it as soon as it happens, so that we can be proactive instead of reactive. And so let's go back to that. Okay, let's talk about that $1 million drug claim. And it's really important that your contract is written cohesively from beginning to end of how you're going to handle that. Because
Correct.
like you say, the stop loss may say, no, we're not covering any of those, but you haven't precluded it in your plan document. You have to
So
make
there's
sure
a gap there. Right.
you have a gap.
Mhm.
And so it's really, really important to work with people that are looking at all pieces. And I'm not doing a sales pitch for Allison and I, because there's plenty of good consultants out there, although we're really good. But it is so important to make sure that you are working with somebody that actually pays attention to those things and is always looking out for your best interests. No one's perfect. Everyone's going to make mistakes from time to time, but the more you can do on the front end to avoid those gaps, those pitfalls, and those contract conflicts, the better experience it's going to be for everyone.
Correct.
That's exactly right. And, you know, to be honest, this structure doesn't work without an engaged consultant. It doesn't, because we need all of the help we can for the employer to be reviewing things from day one. And you all will be getting the information first, then relaying it up to us. You know, we all have to work cohesively and together. And everyone's just got to be on the same page about the end goal, which is protecting the client's interest.
I want to add a little bit to that, because as we talk about this can be very intimidating for an employer. Oh my gosh, there's all these things.
Mm-hmm.
Nancy and I do this for our self-funded clients. We just have an easier time doing it when we have better access to data. And we haven't discussed that, but many more employers are now saying, well, why can't I find this information? And when we can get it, then we can actually do a pretty good job of containing costs and then allowing you to reinvest that into your workforce or put it on your bottom line or buy a Tesla, whatever it is that you want to do with it.
Your choice.
It's your money. It should be responsibly spent. And these kinds of arrangements just allow us to do our job better.
Right. Transparency is key here. That's the thing. You know, this is your health plan. This is your captive. This is your information. So transparency makes this work.
And it's marginally more important than a paperclip or a printer.
Correct.
Absolutely. And people spend a lot more time in investigating the purchase of a new printer than they do the purchase of their health plan.
Yeah. It's all crap, you know. Well, I think people just expect to pay health insurance premium. It's expense. They write a check and then they're done. But this is a way to invest in yourself and turn the expense into an asset. I mean, I can't say it enough.
I think that's a great comment to leave it on.
I think it is too. So we have answered all the questions. We've had a pretty engaged audience today, and you can reach out to any of us with any further questions, and we look forward to seeing you next time. Thank you, Gabby. Thank you, Nancy. Thank you.
Thank you for having me. Nice talking with everyone.
We'll see you again